Good evening, everyone. You're all very welcome to this week's weekly market webinar. Looking at all of the major teams. Obviously, the data prints coming up for the week as well. And of course, as we move into month end today, ending Q3, of course, we will be looking at that as well in the broader sense of things. So I suppose first things first is obviously looking at the data today. We've seen obviously European, German data slightly higher in terms of the consumer price index and harmonized consumer price indexes. Of course, these are lagging indicators, so it's important to obviously look at these for what they are. Joel's numbers this afternoon in the US did come up slightly better than expected, with 27,000 above the 7.2 million. In terms of expectations now, but of course the big real draw this week is of course leading towards the ISM data tomorrow, which will be very interesting, and of course into Thursday and Friday, where we have obviously non-farm payrolls on Friday, and of course the weekly jobless claims and initial jobless claims on Thursday with European data prints. But when we look at broader things overall, from a sectoral output, September closing higher, so this narrative or theme we've talked about over the last few weeks that it hasn't really been playing out, and of course we are seeing that bite back as buyers assume control into month end. Now, when we look at face value from September, beginning of September, we saw that initial dip opportunity. We saw a little bit of a correction last week, and it was really interesting to see, would we actually see further systemic selling beyond those lows on Thursday. And of course we did talk about that on Thursday in our US Open. And really looking to see, because of course a lot of those were hitting pivotal levels on the correctional movements. So when we looked at obviously the FOMC lows created on the 17th of September around that 6600 level on the S&Ps, and of course we had very, very similar movements on the NASDAQ around that 24,250 handle, and similarly as well with the Dow Jones around that 45,600, 45,800. But of course the Dow actually held up the best because of course we didn't actually really revisit those lows. We kind of had a brief flash in the pan last Thursday, but ultimately from then we have seen obviously equity markets progress back into or close to those all-time highs. Of course, Friday and Monday we saw that extension higher. Monday evening into Tuesday today, we've seen a little bit of a bite back pre-market this morning in the likes of the S&P and the NAS, but overall we are seeing buying into the close again, and we can also see that emphasized on the 1 hour prints, where markets is holding above the value area on the day. So on a sectoral weighting basis, we have to see that these markets, risk sentiment in traditional equity markets is still holding up beautifully for the likes of the S&Ps, for the likes of the NAS on the higher time frames, daily, 4 hour, and of course on the weekly as well. When we go up to those higher time frames, of course we had that little bit of a bite back last week, but markets overall into the end of September is holding up very, very well. Now, something we haven't discussed and is obviously present in market conditions at the minute is the narrative around this government shutdown, and I think that's something that we are seeing a little bit more on in terms of Bloomberg and Wall Street. Analysts obviously factoring in or forecasting potential for a government shutdown. Trump did mention it last week, of the likelihood of a shutdown, and was quite likely. Now, what does that mean for the economy? Well, it actually leads to, if there is a systemic, not to say it will happen, but on the off chance it does, it actually leads to delays in the reporting of data. So our traditional calendar events that we would look at, the PMIs, the GDP figures, the ISMs, CPI data prints, they actually end up being delayed. So what that means is a government shutdown is essentially that. It's a shutdown of all of the different bureaus that have calculatory factors for economic data for the economy. So that is obviously something that we do have to be conscious of if it was to emerge over the next week or two, and for how long if that was to play out as well. So although it's not a really present risk, it is something that traders and analysts may start forecasting as we move into October, and that is obviously given the fact that we have seen markets progress so systemically higher through the month of September, that we do obviously have to be conscious of any sort of negative risks, annotations to the markets can spook it down. And of course, as we sit below 6,700 tonight in the S&P, under 25,000 or 24,700 in the NASDAQ, and just off the all-time highs at 46,500 on the Dow Jones. Markets has been very, very fluid. They have been very, very progressive to the upside, but there is inherent market risks underneath the waters, so to speak. So this is where the next week or two has been very important. We know traditionally October, November, December tend to be bullish months as we get the traditional Santa rally, equity markets rallying into year end, should I say. But given how progressive September has been, just be mindful of that as we move into October, that the first couple of weeks might be a little bit more choppy, might be a little bit more nuanced, and there might be more narratives to focus on from a higher level in terms of that. So as I said, as we move into month end, markets has been incredibly progressive. We've got a very, very busy week this week. Obviously, data prints tomorrow, ISMs, European inflation data, then of course Thursday following up with Swiss data, and of course US data, and then of course Friday NFP. And we know obviously NFP, we're kind of taking NFP with a pinch of salt at the moment because of the ride revisions, because of the continuous systemic revisions after the fact. So not alone will we get, obviously on Friday will we get September's job prints, but we'll also get August revisions as well. And we have seen quite a significant revision in some of these NFP payrolls. So NFP is a lagging indicator. So when it comes to indicators that are lagging, it's important to actually know what's a leading indicator for economic data and what's obviously a lagging indicator in terms of that. So when we look at leading indicators, of course we're looking at global M2, we're looking at yield curves, we're looking at general performance in tech stocks, we're looking at overall financial conditions. And so financial conditions is driven by the business cycle and not necessarily driven by the likes of GDP and CPI. GDP and CPI are very good indicators of how the economy is performing, but they are lagging indicators by roughly kind of 3 to 6 months in offsetting, with the likelihood of it progressing even further, depending on obviously the timeline and the curve. So obviously month on month, Q on Q, and year on year. So just have to be very, very mindful of that. But overall, it's obviously something to be kind of mindful of as traders and as kind of macro guys that some of us might actually be in terms of these markets. So as I said, very, very busy week ahead. We're going to kind of take it session by session this week because, of course, how progressive these markets have been into year end. Now, as we look at risk sentiment, I think it's been quite interesting the last few days because, of course, we had that spill-off effect last Thursday. We've had a very, very prominent buyback on Friday. But for some of these markets, it's just been a steady grind. So you look at today, for example, on the Dow Jones, very, very choppy, very back and forth. We had a little bit of a pullback yesterday afternoon on the US Open. And then really since then, it's been kind of back and forth in the session. So today has been one of those days where it's like, for example, trading in a range, taking highs in liquidity, taking lows on liquidity, and then trying to find its fair value as we progress through the session. Same type of scenario on the NASDAQ on the session. S&Ps as well was progressive. So again, NASDAQ very consolidated above and below the value area through the course of the session and is trying to close basically at highs of the day. So we're really looking for more of a characteristic breakout, whether it's progression to the upside or whether it's a complete rollover tomorrow and for these markets to actually subside and move back lower. So at this moment in time, risk is very much heightened to the upside. The trend has been the trend is your friend scenario still continues to linger, still continues to play out. We're getting those apexes, we're getting those correction movements like what we saw Wednesday, Thursday last week, but buyers are still holding firmly in control. So if you are long on pension funds or ETFs or anything like that, where you're kind of looking at a kind of the longer term play, you are seeing you're reaping the rewards of that, and you're reaping the benefits of that ability to just buy and hold dollar cost average into funds. You are seeing that without having to take too much excess risk. And of course, over the last 2 years, it really looks like the NASDAQ and the S&Ps are probably on course for back-to-back 15 to 20% year-on-year gains. So again, just by doing the buy and hold scenario, you can see actually how it's actually proving to be very effective without having to day trade, without having to navigate around short-term news and volatilities. So that won't always be the case, of course, but at the moment in time, we are seeing that evidently play out within the broader markets. Now, looking at that broadly, It's a centralized theme across the board in the US. We talked about that over the last number of weeks and months, looking for that kind of outperformance in the US compared to Europe and some of these other equity markets. And of course, we are seeing that as well playing out. Now, as we move back into Europe, we have seen this DAX become very, very consolidated, very, very choppy over the last number of weeks or so. So we had the DAX trading in those lower bounds between 23, 23 and a half. We have seen it break back above that 23,750 handle today and actually progress above 24,000 for the first time really since the beginning of September. So we talked about how, again, September lows, markets actually sold off. DAX has been fairly consolidated, while at the same time, of course, this was the September low. So again, showing the illustrative outperformance when you compare the US equity markets, which again, if we just use the first of the month compared to where we are now, up around about 3.5% for the month. And of course, the DAX, which is in actual fact probably going to close lower on the month. So you can see how there that segmentation, that I suppose that nuances and equity flow from the European equity markets into the US has proved to be a predominantly figure through the month of September, and we're seeing that outperformance as we've talked about over recent weeks. Same again, I would only say the better thing with the FTSE is that the FTSE has been massive headwinds off of the mining extract. So if you look at the FTSE composition, we have seen gold, commodities do quite well, and that is obviously hard commodities. We're seeing silver just off all-time highs. We are seeing gold at 38.50 as we move into tonight, and again, systemically continuing to break higher. So naturally, when these commodity markets do quite well, that is again giving some short-term headwinds for the FTSE. And of course, we see the FTSE today at 93.50. So for those longer-term traders of the FTSE, which continue to be in those significant range bounds like what we saw in 2024 and pre-COVID, those are no longer the case. This is just continue to break out, continue to extend higher off this commodity super cycle. And it would not be surprising if we saw FTSE 100, and I would probably expect that if gold was to get to 4 and maybe try and progress through 4,500 next year off a continued super cycle phenomenon, then it would not be remotely surprising if we saw the FTSE to get to 10,000. So again, interesting narratives to watch out for from a short term, medium term, but also on a longer term perspective. And as I said, looking then at kind of out of the equity market side of things, when we talk about Europe, when we talk about the UK, and when we talk about the US, naturally, what are we seeing in gold? Well, we're seeing those apexes, we're seeing those corrective movements. We saw it obviously in September, we talked about it. Beautiful buying opportunity around the 36.50 level. We actually talked about it on multiple sessions. Unfortunately, last week when we got that dip, we didn't quite get that retest of the 3,700 we were kind of talking about and kind of looking at. Kind of bottomed out around the 3,700, 3,725. So that unfortunately didn't trigger. But even when we look at the price action over the last few days, again, apexing up, aggressive breakout, segmented continuation above it, only to get a little bit of an unwind very, very early this morning. Now, this is very, very choppy volatility, going from 38.70 all the way down to 3,800. That's a $70 movement in just 4 hours is immense, only to see an immediate bite back into 38.50. So volatility is up. The inherent movements within these commodity markets is up, and again, we're talking about silver at nearly $50 when it was trading at 33 an ounce just 3, 4, 5 months ago, and you're seeing a similar scenario in gold as well. Successive all-time highs, continuation to the upside, creating those short-term corrections, and this is the easiest trend opportunity we've seen all year. And we talked about how extensive it was even down here when we had this massive consolidation through May, June, July and August. We had that breakout, and we often see it as well when we compare it to Bitcoin. In the alternative digital asset class, we talk about how gold leads the way, then we get those cyclical rotations, and that'll be interesting to watch as we move into Q4. We talk about October, we talk about Moonvember, and of course Bullcember, December. It'll be very, very interesting if this is the consolidation in Bitcoin where we ultimately see it progress into the 130s, 140s, 150s, and actually start to cyclically follow what we've seen in terms of the consolidation element earlier this summer in the gold market. So that'll be interesting to watch. It'll definitely be something I'll be watching myself as we move into Q4. But even again, as we see it in the BTC charts, holding those 109, 110 lows that we've talked about, discussed, and noted recently, and that aggressive buying opportunity over the last 2 or 3 days, end of last week, beginning of this week. Now, of course, remembering it's 7 days a week trading cryptos, and again on Sunday and Monday, aggressive inflows in capital, and we're seeing it as well as we look at BTC tonight, get aggressive break off of that 113 and value area on the session. So commodity markets up, equity markets up. Volatility curve is steepening to the upside, but isn't affecting investor sentiment and risk appetite that much. It's creating those short-term correctional movements, but buying has resumed nonetheless. So we just have to be conscious of that yes, there is the anecdotal conversation that when VIX rallies or when volatility increases, markets tend to sell off, like for example what we've talked about in the dollar and gold and S&Ps last week. But again, these moves tend to be a little bit more temporary. Now, when we talk about the VIX volatility curve tonight, I think we also have to look at kind of those segmented short-term movements, the session-to-session movements, but we have to be able to look at the longer picture. Now, when we look at the longer picture, we can see, and over the last few weeks we've talked about this range between 14 and 17. We seem to rally into 17s, creating kind of short-term risk-off movements, and then when we pull back from 17s, moving back into those lower thresholds, the equity markets tends to kick on. And we've seen that kind of pretty much visual probably through the month of August, more systemically really from the beginning of September, and that has been anecdotal, as I said, in these equity markets, creating short-term dips, creating short-term dips, creating short-term dips. It's no surprise that these dips in these equity markets has come from spikes, short-term spikes in the volatility curve. You can see it for yourself. If you match up the dates, they will align perfectly. But the thing we'd have to also say is, when you look at the volatility curve over the last kind of 12 to 18 months, majority of the time it spends its region between kind of 14, 15 lower bounds, 18 short-term highs, but more systemically when we look at it over the last 4 to 6 months, really from those April-May highs when we had that aggressive 20% sell-off in the markets, when volatility obviously peaked into 60. Since then, it's just continually drabbing lower. Now, I do think this is going to be probably the continued mandate until we probably get to about Q2, Q3 of 2026. And I think that will be the next time I'll be looking for a break of the VIX curve above 30. I think when we start to see the midterm elections coming through, we know midterm elections as a calendar year performance next year, and you look at 2022, 2018, 2014, they were all negative years or posed a lot of downside pressure. 2022, for example, in recent times, sitting at around about 20 to 25% down as a market correction. So those are the type of things you'd have to look at when you look at debt cycles, when we look at business cycles, and of course when we lead into those midterm election cycles as well, which tend to be the negative year of the four. And we know, traditionally speaking, if you were to listen to any of those traditional equity analysts, you know that roughly every 1 in 4 years is a kind of 15 to 20% down year. So really looking at that to probably kind of subside the volatility, and then obviously looking for volatility to then kick on as you move out of Q1 2026 into Q2, Q3 and into Q4 next year. So until then, obviously we're looking for any sort of geopolitical events, macro fundamental events to create short-term spikes, like for example what we saw here. But I think the curve is where it is for a reason, and we're seeing that very vividly over the last kind of 12, 24 months in particular when it comes to the VIX volatility curve. So at this moment, VIX remains entrenched in these deeper regions, and that means it creates that exuberant investment cycle. When we do get the short-term increases in the VIX, it creates these 2-3% pullbacks, right? And we've seen plenty over the last kind of 2 or 3 months in particular, and in fact you can name 1, 2, 3, 4 in the last 6-8 weeks. All right, so just be mindful of that. And of course, the other secondary element is the DXY. Okay, so we've seen that aggressive move last week. We talked about it into 98.50. Probably called it ideally looking for that move back into this yellow area, which is really kind of that retest. So what have we looked at over the last 2 weeks secular in the DXY? Was consolidation, breakdown, followed by apex. Breakout of yearly lows, which didn't obviously sustain. We talked about that on FOMC night. Then of course from the FOMC into month end, we've seen this kind of ABCD correction move back up into 98.5, followed by secular decline back into 98. And of course we drew that out last Thursday, and we're looking for that kind of short-term pressure on the DXY moving back into this region. Now, when you look at it on a daily perspective, and really kind of isolate it, you can even actually remove this temporarily. A lot of the price action structure is really down between 97.50 and 98, and I think that is going to be very, very interesting as we move into end of September tonight, and then of course as we move into NFP on Friday. A lot of the market is going to be watching this 97.50, 98 very handy, right? And very closely at that, really to determine whether we get a symbolic another leg lower, okay? At which point then that 95 region comes into play, or if we get a secular kind of hold of these lows at this 96.50, 97. Now, my own personal opinion is that I would love the DXY to go lower, right? I would love the DXY to do one more final move, secular, try and break into that 94, 95 print. But at this moment in time, it's still yet to be determined. The other thing we have to look at is that every time we've had a structural dip opportunity, followed by a correction in the DXY, it kind of has labored, right? So when you look at it from here, for example, in April, very, very sharp decline, dead cat bounce recovery into a new low, okay? That's the first thing. We get a very, very similar type of move, dead cat bounce into an attempted but failed new low. Now, from there, if you isolate the price action over previous weeks, again, showing downside pressure into those new lows, suggesting that it was going to break, but ultimately it didn't, to create that impulsive move back up into this region. And that's why I'm saying here that 97.5 to 98, but 97.5 into 98.5 is proving to be very, very choppy at the minute, because it's just a continuous segmented back and flow between short-term buyers, short-term sellers, in the likes of the DXY, in the likes of Eurodollar, in the likes of dollar yen, in the likes of cable. And of course, we are seeing that segmented move short term back into that 97, 50, 98 handle. So this is really kind of where things are going to become very, very juicy, very, very interesting. Potentially, as I said, with the shutdown, government shutdown, could that be a narrative for weakness, that dollar weakness maybe into middle of October? Let's wait and see. But so far, we have seen that segmented break up into this 98.50, just looking at pure price action. But incidentally, we've failed up in these upper bounds, and you can see that multiple reactions and failures up around this level, only to come lower back into these secular regions down here. So as I'm saying now tonight, it's important to see how does this DXY react in this lower bound. I think if we start breaking through 97.50, then you have to start looking at a further continuation of short-term dollar weakness, which then brings in those rebounds, those rebounded lows that we saw at the end of May, beginning of June, but incidentally again off of that FOMC low at the 17th of September being potentially revisited. And that is obviously something we're going to watch very, very closely over the next few weeks. And that would then be the cause and effect to see, well, if there was narratives, if there was hypothesis for us to take this lower, that's really then you'd look for further deepening selling pressure for that to come through. But as of yet, still yet to be confirmed, because as we saw last year in 2024, and we talked about it about 8 weeks ago, we talked about it vividly, that last year when the Fed cut rates, the dollar actually strengthened. If you went back to 2017, 2018, way back over here, what happened? Dollar strengthened. So we just have to be conscious of the fact that the dollar doesn't necessarily mean that it will go lower in the face of the Fed cutting rates. And that is something that we do have to be very, very conscious of, that yes, on a fundamental level, when as central banks are cutting rates, that's generally a weakening of the currency, but not necessarily the case as you take 2024, for example, and 2018, for example, as well. 2018, for example, as well. So we just have to be conscious of that as well. So we've got multiple narratives. We've got the fact that September was so bullish. We've got an entrenched or weakness in the labour market in the US, followed by price stability. Not going to say concerns, but elements that the Fed is obviously going to have to look at. And then, of course, when we look at the debt cycle, where the global debt is going to have to be rolled, there's about 9 trillion of global debt, which the US is going to look to try and refinance at lower levels. And then, of course, when we look at, as I said, the Fed obviously within its rate cycle cutting rates. And that is obviously something we're going to have to focus very closely on. in line with M2, global monetary supply, as we look at that progressing into Q4, October, November, December. Now, what's also around the corner in the next 3 or 4 weeks is Q3 earnings. And we talked about how in Q2, in July, when we did our last kind of sectoral review of earnings, around about 40 to 45% of the stocks in the first couple of weeks alone. Now, this wasn't even just all the stocks, but vast majority of them in the first couple of weeks that had reported. Of the 45, about 75-80% were beating expectations. So we want to just see how does that factor in as we progress to Q3. Is there any cyclical concerns? Is there any lingering offsetting effects from the tariffs? Is there any other elements of consideration? Now, but if you look at GDP, which last week had a massive beat, you would actually probably say that these stocks are evenly poised to portray potentially another successful earnings season. But of course, we'll find out over the next calendar month. So that'll be something to watch out closely. So we've got 3 or 4 narratives to watch out for. Obviously, M2 supply is going to factor into consideration as we move into the end of December. And really looking to see, as I said, how does this dollar play out as we move into Q4. Now, if you look at from year to date on the dollar, you will see yourselves from where we were at the beginning of the year. This is where the dollar was at the beginning of the year, up around 109.5, between 109 and 110 in the first few weeks of the year compared to where we are now. We're trading down around about 13 points in the index when it shows the sectoral weakness in the DXY over the last, as I said, 9 months or so. Now, again, you're seeing about 11% down on the year. Now, as we look at that, obviously, as I said, we've talked about the VIX curve. We've talked about the volatility side of things. That's going to become, or can continue to become of importance as we move into Q4. Particularly, any short-term spikes allows for those pullbacks. And you kind of have to treat it like that any short-term spike in the VIX is that 2 to 3% counter trend movement. Might get 5% if you're lucky, but 2 to 3% has been your floating average when you look at the last kind of 3-4 sectoral pullbacks over the last 8 to 12 weeks. But again, knowing that buyers are very, very quickly snapping up these markets to the upside, at which point now we see, as I said, S&Ps at 6,700. My year-end target for the S&Ps way back in February, way back in March when we were trading down here at 6,000 and 6,100, my target was 6,500 for the year. I've absolutely no problem reaffirming that viewpoint. But from there now, to see the S&P go back to 6,500, very, very unlikely. And in fact, you'd probably see the S&P being rewritten by a lot of forecasters. I think 68 to 69 is now the revised forecast on Wall Street. Wouldn't even be surprised if we saw 6,900 into 7,000 for year end. But again, it's contingent on all of these different elements playing into the hands of the upside. Okay, so that's a kind of a synopsis into month end. I think it's really, really important tonight that we actually take a step back and look at the broader scheme of things. Obviously, seeing equity risk exposure continue to do quite well. In the crypto side of things, it's been a little bit of an anomaly because, of course, when we look at the week-to-week, month-to-month performance, you'd actually see, right, Bitcoin very, very bearish last week. It saw a very progressive move off of that 109, 110 figure. And it's actually looking like tonight, only for the last couple of days in particular, it's looking like it's actually going to close bullish for the month. So we know September seasonality is generally a negative month for the crypto markets. It's actually seeing a little bit of green as we move into month end as well, which is quite surprising because, of course, only a couple of days ago, last Thursday, last Friday, we would have been net negative for the month. So it's mad within 2 or 3 days. A 3-4% move over a short period of time has saved the month for the crypto side of things. And again, Ethereum, on a short-term perspective, it's been navigating between 4 and 4.2. Not really surprising at that because I still think we're still in that kind of phase 1 cycle. But again, when you compare BTC to Ethereum, you'll actually see that Ethereum is retesting that monthly breakout. And of course is proving to be negative on the month. And of course, if you start to dial down through the altcoins, XRP, Solana, some of these other coins, all proving to be net negative on the month. And again, Solana as well was at 230, was at 240, is just about holding on the monthly. But again, was very progressive at the early parts of September and is shown to be just about holding up into the green. So you'd actually have to say that Solana is probably outperforming Ethereum. There are some, in the crypto side of things, there are some other projects that have done incredibly well recently. Aster to name one, Hyperliquid to name another. So there is certain projects that are outperforming against the curve. But if you were to look at BTC, against the vast majority of the market, you would actually see BTC be accruing asset appreciation against those. So basically the altcoin market is obviously a little bit lower, but again, not really surprising, because of course we still are very, very early into the final echelons of this kind of current crypto bull market. So obviously just kind of factor that into consideration. So as we move into really the rest of the week, a month beginning tomorrow, we want to obviously see how does that progress. We are seeing equity markets at or close to all-time highs. S&Ps, for example, just off all-time highs. Very, very interesting to see if we see this continue to break out. On the daily chart, you'd actually have to say probably still poised to the upside despite yesterday's wick rejection. 24,800 on the NAS is going to be very interesting. 6,700 on the S&Ps, very, very interesting. And of course the Dow has been quite choppy for the last week or so, because of course we had sectoral breakout, we had retest, we had extension, apex, and then really since then the Dow has kind of stuck in this range between kind of 46 and 46 and a half. So we want to see, does the Dow actually creep out on the daily, which it's trying to do, but it would have to get a daily closure above that 46 and a half for me to really start to continue segmenting further all-time highs to the upside. But it's not far off. That's the only thing I would say. So tonight, as we round off, we're looking at equity markets, gold markets, commodity markets at all-time highs. We're seeing dollar continue to remain range bound between 97.50 and 98. That is going to be the precursor for me for the week, really to see how does that dollar react between 97.5 and 98, given of course we've had A, B, C, D, and given of course that we've had that extension lower back into these two lower regions. Now 98 was the retest level here, but beyond that it's really a case of how does it extend into obviously NFP on Friday. I'm really seeing, does the dollar try and break out again above 98? So 98 is my bull case scenario. It needs to break above 98 for me to really kick on, and then if it does kick on above 98, I would actually look for it to try and take out those highs above 98.50, so 98.60 up into 99, and really kind of creating that type of impulsive move. But again, let's see what happens into Friday. If data doesn't align and we see a little bit more segmentation out of dollars, then of course euro dollar is going to continue to remain range bound, but probably at those lower bounds between 116 and 116 and a half. So you can even see yourself in euro dollar over the last number of weeks, new all-time highs, followed by corrective movement, followed by consolidation in recent months, July and August, followed by short-term breakout, followed by retest, followed by instigation of new highs, short-term highs, sectoral highs into 119, which ultimately took out this short-term high, but this absolute high. So you've got absolute high, lower high, both of those were taken out, and then from there it's that kind of sectoral unwind, creating that apex opportunity, flowing capital back down into this prior consolidation piece. And of course from there it's really a case of, does this 116.50 handle hold up? For me, that has to hold up this week. Otherwise, if that starts to go, if that 116.50 starts to go, then you'd actually look for that DXY to break back above 98 and really segment to the upside, and as I said, have a run at 99. And then of course you're really then looking at the daily perspective, where then it says, well, you've had that correction movement, you've had this decline, you've had the false breakout, you've had the instigated move back above this prior short-term consolidation here, which is, as I said, around 97.5. You've had the kind of the inverse head and shoulders creating out as a technical pattern, and then you're really looking for that continuation on, which is, as I said, back up into 99. But again, we're going to watch it day by day. We're going to watch it as it progresses and really seeing how does this price structure develop, because even on face value, euro dollar very, very choppy at the minute, so it's kind of reacting on a dime. Okay, and that is obviously something to be conscious of. But tonight, sitting just below 17.50, 116.50s are absolute lows. I think if it starts to break underneath here, then you're going to be altering our structural view of euro dollar. And again, similar type of scenario in cable. You look at cable as well, really here, structural highs under 138s, really retesting those lows at 132s, then kind of finding a period of consolidation, followed by retest of highs, which subsequently rejected, creating a lower high, and then creating a break of this prior internal structure, only to come back up and retest. So this is kind of where things get a little bit messy again on cable. You can kind of see for yourself, very, very back and forward, retest, rejection of highs, systematic breakdown. We talked about this systematic breakdown 2 weeks ago. We're short cable, and then of course marginal new lows, only to return back up into that 135 handle. And again, 135 is effectively your midpoint range between your absolute lows, which was in the middle of May and beginning of August, and your absolute highs, which was again noticed mid-July and mid-September. So of course that is going to become a very, very interesting level as we start to get more clarification on where and how this dollar reacts off of these 97.50 handles short term. All right, so that's kind of where we are from an FX perspective, from a VIX perspective, from a gold perspective. Gold still very, very bullish. For me, it's even very difficult to try and find pullbacks. It's these types of structures here that are absolutely clean that you must try and take advantage on, providing the trend holds. This type of movement where it doesn't pull back, it kind of pulls back to kind of an intradaily or intra-weekly a short-term value area. Yeah, you might get a sniff of it, but otherwise you kind of want deeper pullbacks. And then today, for example, that aggressive apex followed by corrective movement followed by move higher, very, very difficult to try and trade that. And if you're trading it and you're winning, fair play to you. Okay, so that's really kind of where we're finishing the week. BTC is closing higher on the week. Ethereum is closing that monthly. I would expect it to continue closing weaker. I do like the idea, although it has kind of created that breakout followed by structural retest. I think for me, any weekly closure back above 42.50 on Ethereum signals further buyers. And even when you look at the price action structure, it created that V-shaped bottom only to come back up into that 42.50 and incrementally fail yesterday before the Ethereum price has unwound from 42.50 back into kind of 41.50. So unless you're getting a daily, I think daily weekly close above 42.50 this week would bring in more buyers to Ethereum. But that will be something to look out for over the coming days. And again, considering we had that aggressive movement, I think that's probably the bottom. We might get a retest of those lows, or maybe an entrenched low again back to 4,000. But I'd be surprised in October if we were to see Ethereum below 38.25, 38.50. That's my personal opinion. Solana, if we go to that daily chart again, just to kind of round off on that one, this was kind of the incremental area of interest. So of course we've had higher high, kind of higher lows, continually breakout into that prior all-time high at just under 250 or 255, followed by correctional movement back into 190. We talked about that move last week. We actually mentioned it on last Tuesday call, the probability that I wouldn't be surprised if we saw Solana go to 190, 195, 200 range, and we actually got it, which is quite surprising how aggressive the selling was. And then of course we've seen that dead cat bounce recovery back into that 210, 215 handle. So for me, a break above 215 signals further progressive bullishness to the upside. But for that, Solana has to break above this yellow area to really start undoing this corrective retrace that we've seen over the last number of weeks. Now, again, you have to look at the DATs. You have to look at the Solana buying DATs, the Ethereum buying DATs. So obviously, that's going to become very, very interesting as we move into October, November, and December. But so far, so good. We're getting those pullbacks, we're getting those dip opportunities, we're getting those buying opportunities. Just be mindful that if you're trading crypto on leverage, these markets are incredibly volatile. So take, for example, from the Solana high to the short-term low, you are seeing 20-25% movements. So these are normal for a very, very volatile asset like Solana, like Ethereum, like BTC. So you just have to be conscious of the asset that you're trading in and making sure your risk is positioned accordingly to the volatility curve of the asset that you're trading. All right. So guys, we're going to leave it there for this week. I'm going to kind of do more short-term run-throughs tomorrow. These markets quite choppy at the minute, very back and forth. Looking for more depth and more substance really for directional bias in the likes of Eurodollar, in the likes of cable, but that's going to come by the underwriting of the indexes. So the DXY, the VIX curve, which we've obviously seen pull back today from that 16 and a half handle. So again, VIX volatility curve tried to break through on Friday, failed, got a short-term bump yesterday, failed at 16 and a half, has moved lower, filled yesterday's gap. So I wouldn't be surprised if again we saw the VIX move lower over the next few days. If we see that VIX run lower back into that 15, 14 and a half, all that's going to happen is S&P's is going to go to new highs, NASDAQ is going to go to new highs, Dow Jones is going to go to new highs, and we're going to see that segmentation continue to the upside. All right, so guys, we're going to leave it there for tonight. I will be back tomorrow for US Open, watching closely, of course. As I said, tomorrow, quick round through the calendar. There is obviously Chinese holidays this week, 1st of October. There is also 2nd of October, but there's also more holidays in China throughout the course of October as well. I think it's middle of October and then back end of October, so there's more holidays to come there in Asia. And then, of course, just taking it day by day. So Wednesday tomorrow, as I said, European Harmonized Consumer Price Index. We've got ADP employment change in the US. We've got ISM manufacturing output. And, of course, we have then moving into Thursday, we've got obviously the employment data with Friday's NFP then to follow to round out the week. And, of course, taking NFPs lately with a little bit of a grain of salt, considering the revisions and the outlook shifts month after month in terms of the revisions. So we're just kind of taking that just with an element of cautiousness. All right, guys, have a lovely evening, trade safe, and we'll see you all tomorrow. Thank you.